We are talking July inflation, what the numbers are doing. Are they rising? Are they falling? With me here is Jim Rounds, local economist with Rounds Consulting, and we're going to go over the inflation report for July. Jim, let's go over the top line numbers first. The BLS reported a 0.2% increase in all items, that index from June to July. But the number that we're all familiar with, 2.7% annualized inflation. Are these the numbers you were expecting to see?
Yes. So the 2.7 is pretty much close to the long-term average. There were a lot of people that are expecting the tariffs to be pushing inflation up, but there were such delays in implementation, and we're not going to really see a lot of the businesses wanting to adjust their prices and maybe raise their prices before their competitors. So at first, the businesses will eat some of the additional costs that'll be paid for the imported products, and then it'll get passed on to the consumer eventually. So we may not see the really significant increases in inflation until maybe this winter.
Okay. All right. Well, let me go over really quick what I want to go over for our audience, so they can understand the consumer price index. I mean, everybody talks about inflation. These numbers come from the consumer price index. What do these numbers mean to an economist, and how you use it, but also why these numbers are important for regular people?
Well, there's always inflation within the economy, and so you expect to see, like I mentioned, between 2 and 3% each year. And economists use that because you have to make adjustments. If you're looking at historical data, you want to compare apples to apples, not apples to oranges. So you utilize this kind of data, but it also gives you a signal of how the economy is doing. And it gives you a signal on how the Federal Reserve Board may act. Because if you have high inflation, but you also have some problems with the job market, they may be in a position where they don't take action. If you have lower inflation, they might have the ability to maybe lower rates later, and that impacts everybody. So you use it for a lot of different things. It's one of the top, maybe, if there were 5 key economic statistics that economists look at, inflation would be one of those.
So, out of curiosity, whenever people look at these inflation numbers, say, for example, let's go back to 2022 when we had very high inflation. We're talking in the 9% range. I believe it got up to 9% in 2022. Now, one of the questions that people have when they see, 2.7 is they never really saw this number go negative.
That's right.
It didn't. No one saw, we got, minus 2% inflation this month in the report. And so why is that, and what does that again mean for an economist?
Yeah, that's actually a big deal. So historically, if you look at an economics textbook, you see deflation where inflation's going negative, and it indicates there's a lot of other problems. But we had these really high rates of inflation, so prices went up, and now people are misinterpreting what's happening because they're saying, okay, well, inflation's about back to normal, so prices are back to normal. No. They're still high, and they're still growing by 2.7% per year. So we really haven't had that relief. And the key this time around in evaluating the economy is what's it going to take to get back to normal conditions? And in this case, what are normal prices? And we kind of don't know what the normal prices are because we have tariff issues. The economy is starting to slow. You're seeing that in the job numbers. So you're in that period where you see a lot of changes in the economic data. And that's one of the best signals as well. When you see some good data and some bad data, you know things are sliding. When you see all bad data, you got a recession. Then when you see it mix up again, we're starting to see a recovery. So looking at everything in the aggregate is important, but you also have to look at these key factors. So employment I like to look at, inflation I like to look at, and I also like to look at local government tax collections because there's surveys out there asking people, are you going to spend money? Are you worried about the economy? They're like, yes, I'm really worried, but football season's starting, so I'm going to go buy a 80-inch TV. But you look at the tax collections, you can see actually what they're doing. So there's some key statistics to look at, and this is one that's really telling, but this is also one that's getting more controversial too.
Sure. Now there's another number that's thrown around in these reports. It comes out every month along with inflation. It's called core inflation, or that's what economists refer to it as. So what is the difference? And it was higher than regular inflation. So again, what does that mean for people when someone says, at 2.7% inflation, but core inflation was 3.1% and rising?
So the reason that you back out, when you get down to core, you get down to all the basic items that you would typically see, but you don't include say the cost of gasoline, because that can go up and down for all sorts of reasons. Bad public policy in California could raise it here in Arizona. There could be infrastructure issues, sometimes changing over fuel types. So those numbers can go up and down. So we like to back some of those really volatile ones out to see what's the underlying inflation rate. And so what we ended up seeing happening is we had fuel prices go down quite a bit because they were inflated, especially in Arizona for a long time. Home prices went up a little bit though, and that's going to vary depending on what's happening with Federal Reserve Board interest rates and what people can afford, because it's not so much the cost of the home, it's the cost of that mortgage payment. So it's good to break out the really volatile pieces and just see what the stable pieces are doing. Are they going up or down? And they tend to move more gradual, and it points you in the right direction of where the economy is going.
So speaking of stable, let's talk shelter really quick, which is the BLS terminology for rent and mortgage for the most part.
Yep.
This one makes up about 35% of the calculation. It's huge. This is so much of the number that the BLS puts out every month.
Yeah.
Now, this number has been, such a big impact driver on inflation, especially back again in 2022 when housing prices were just going through the roof. What do you sort of expect to see this doing in the future? Are you expecting to see expected to see shelter sort of calm down? I know it's kind of calm now. Where are you sort of expecting to see this one? Because it's such a big driver.
Yeah, and this gets complicated, but to try to give a real simple answer is there's this, what I call the hermit crab condition. And you got to look up a video on hermit crabs, because what they do is they all line up and the big one starts, the big one moves into a bigger shell, and then everybody moves into the next shell. They just instinctively they do that. Well, that's what happens in housing. The profitable homes, the homes that can still be built, are the bigger, more expensive ones. But what if that person living in the current big shell has a 2.5% mortgage rate? Well, they're not going to move into that next shell, which means no one's moving up, and that puts extra pressure on the lower end. And the lower end is never profitable. You always have to have some kind of subsidy on the affordable housing pieces, even on workforce. So you're going to see if interest rates go down, then that's going to make things a little bit more affordable for people, because again, it has to do with the mortgage payment, not the price of the home. But that would then push the price of the homes up a little bit. And some people actually say, well, that's an indication of a strong economy. Home prices are moving up. Well, not if it's out of balance. Everything has to get back into balance again, and we're still out of balance, like with the overall costs related to inflation that you were talking about.
Yeah, I was about to go there. So with shelter being such a large calculation in inflation, and if you look sort of deep into the numbers, and we will go over them in a little bit, but when you go deep into the numbers, you can see that there's a lot of products on shelves, like things that we buy regularly. We don't, you buy one here, you buy one there. We're not talking groceries. We're talking just like household products and whatnot. You can see numbers are starting to creep up for some of these products now, but these are so much smaller than shelter. With interest rates, most economists are now sort of predicting that interest rates are very likely to begin to start getting cut in September. Now, that should, as you just mentioned, bring shelter prices up as people start to be able to afford to buy a house again. The value of the house might start to rise, which will again start impacting this one calculation. So what is that going to do to the overall inflation number? Are we still going to be stable? Is it a concern that prices are just going to go so much higher in rent and mortgages that it could go out of control again?
Well, that's the more natural impact on inflation, where tariffs are really like an outside influence on it. And so with housing, like you mentioned, you'd see some increase in prices, but at the same time, you're going to see less movement. What I think is going to happen is you're going to have to see interest rates fall by quite a bit to get that person that has a 2.5% mortgage rate, or 3 or 3.5, to say, okay, well, 5 is my target. I can move up into the next home, and I'm going to free up that home for that next hermit crab that comes along and fills the shell. So if we see significant reductions, then we'll see a different activity than if we just see maybe 0.5%. But it's going to depend on when inflation kicks in, because the job numbers are going to be weak for a while. That was the trend. It's just how things are going. They're hard to predict, especially when there's a lot of weird things going on in terms of public policy. And then you end up seeing, like some of the basic data tell you where things are going. But we're going to see the economy weakening, and that's going to have an impact.
Yeah, just a tangent really quick. Those numbers were actually, those job numbers were were fairly weak even before this last report that showed that they were much weaker these last 3 months.
Yeah, well, when we went into it before they lowered it, they came in higher than I was anticipating because I was expecting them to slide. We were predicting, and this is one of my favorite economic indicators, if at the U.S. level, the job numbers that they report every month, when it starts coming in below 100,000, that's when you start to worry. When it comes in below 50,000, you're going to be getting close to recession, but you got to look at multiple months. And so they revised the prior ones down to almost nothing. We had 73,000 jobs created this last month. So that falls into that category, but that was exactly what we were predicting quite a while ago. And I remember that distinctively because I had a meeting with my financial advisor right after the numbers came out, and he said, "Do you want to chat about this?" And I said, "No, it's what should be out there." So for some reason, it's been politicized quite a bit. The numbers are the numbers. You'll see that when there's a lot of different things going on with government policy or unusual times in the economy, you're going to see more revisions than normal. When times are smooth and you have an upward growing economy, or if it's starting to slide consistently downward, you're going to see the numbers not have to be revised as much. But we also have a lot of people like myself where I do a lot of private sector consulting, but I do government advising as well. So there's people that have contracts for government work, but they're still not government employees. Those types of things make it really complicated, picking up those freelancers. And so there's been more revisions lately, and it isn't because somebody's biased, it's because these things are hard to calculate, and that's why you go back and you look at them a second time, and you look at another methodology, and then you revise your numbers later.
I do want to talk tariffs right now really quick, just getting really specific into the numbers. Like, for example, coffee was up 14.5% in 1 year, but just in a month, coffee was up 2.3%, audio equipment up 2.2%, motor vehicle repair, that was up less than 1%. You're starting to see these, these are monthly numbers. Most of the time when we see the monthly numbers in the index, we're talking 0.1, 0.2, 0.3, and you're seeing these double-digit numbers sort of start showing up in products that we buy on the shelf. How concerning is that?
Well, I have a big concern because a tariff is a backdoor sales tax because it does eventually get passed on to the consumer. And we're going to see, again, I still think we're on the very front end of the impacts of the tariffs on inflation. That's why 2.7%, right around the long-term average, not a worry. But as you just noticed, you're starting to see some of the ones that have been impacted already move up. And there's going to be a real issue into the next calendar year, I think, because if we do slide into a downturn and we're in a situation where we have high inflation and low growth, that's called stagflation. That's one of those bad words in the economics textbooks.
Where stagflation is higher inflation, higher prices, but lower like GDP and lower economic jobs growth.
And it's difficult to get things back into balance when things are, you have stagflation if you have things very much out of balance. But a lot of these are self-created. So if we end up maybe pulling back on the tariffs, if there's part of the negotiation is going to be to pull these down further, then I think that's great. But the amount of money that the federal government is collecting from this, it's not net new money for the U.S. It's a shifting of money from American businesses, small businesses too, and general taxpayers, including lower income taxpayers. So it operates very much like a sales tax on lower income business individuals and small businesses, which is not good public policy.
And one of the reasons we haven't seen the tariffs really show up in the data yet is because they were warehoused back in April. There was a lot of product warehousing back in April and May.
That's right, and that had a big impact on GDP because the imports are part of the formula for a weird reason. It actually goes way back to when they had problems with collecting the data. So then we have negative GDP because of that, and then it goes positive again. So even the GDP data is going to be a little bit off for the next couple of quarters.
Now, there were a couple of interesting numbers in here, though, because we're just talking about how tariffs, we're seeing increases in the monthly numbers for inflation for certain tariff products, but we also, the numbers show the opposite in some other products, too, that you just would expect to see being very tariff impacted. Like, for example, televisions. Now, televisions have been not inflating for years. They've been a very static number. Whenever everyone points to, items not going up in price. It's usually TVs that you see, and even cell phones, but they're still there. So even with tariffs, you're seeing TVs went down 2.2%, telephones 1.4%. And of course, gasoline. Gasoline, we talked about that as being something that's been a sort of a price driver down for inflation. But why would you expect to see, if tariffs are having such an impact, those kind of items that you would also, these are heavy import items as well?
So you look at the underlying impacts, and the underlying impacts are when you have technology that continues to change, prices go down. It's true for everything. It's for computers, phones. Can you imagine how much an iPhone would be 20 years ago, 30 years ago? It'd be like a $50,000 item. Now it's almost affordable. But you're going to continue to see that, and so you have this underlying decrease in the prices, and then you have a little bit of an offsetting increase because of the tariffs. And you don't really notice it as much unless you separate it. Where we start to notice it more is where people are dependent on their local jobs, where you start to see some of our businesses that import a lot of products have to maybe pull back on their production levels and lay people off because they can't afford the price increases. And it's really difficult for especially the big businesses to say, all right, I have a president that I know is going to be in here for 3.5 years. We don't know who will be next. It could be another Republican. They might continue the same policies, but we don't know. When we don't know, are we going to spend $3 billion to move a major factory, or are we going to just see if we can get by and wait and hope that our competitors pass along the costs to the consumer as well, so it doesn't impact the business profits? So there's a lot of uncertainty going forward.
So overall, we talked about the tariffs, how they've impacted it, how other things have impacted these inflation, these prices. Where do you see this report, this July report? Like, how concerning is it to you, or is it just? I mean, you've sort of expressed middle of the road. Is that correct, or where's your concern level?
It's exactly where we were expecting. Expect to not see these huge increases in inflation again just right away. It's going to be slow. And what I'm hoping, though, is just because I don't fully trust the Federal Reserve Board for making the right decisions, because they've messed up quite a few over the last handful of years, I'd like to see that inflation at least maintain at a lower level so we can see a couple of rate cuts, maybe 0.5%, maybe a little bit more, and then that'll help economic activity some. It'll have that weird impact on housing, the opposite of what you would think, but on other things, it'll help spur economic activity. I
have to ask you this question. Yesterday, President Trump announced his pick for the BLS commissioner that he's replaced. His name is E.J. Antony, I believe it was. And this pick is drawing a lot of criticism from really all sides, all economics, left, right, center. You're seeing a lot of criticism on social media over this pick. Do you have the same concerns? Are you not as concerned? Where are you with this pick?
I'm not concerned because they're bureaucrats. The director of an agency like that is not looking at a calculator. They probably don't have a computer on their desk, and they're more managing the organization. Now, if they gave direction to purposely manipulate it down at the staff level, that would be something different. But again, all these things tell a story. And if you start to see a couple of data points that are outliers from this broader story and you can't figure out why, then you know that there's something awry. But the person that runs these types of entities, they don't have to be an expert in data. They have to be an expert in management and being able to do, at least in this kind of environment, to do the occasional interview and not sound like an idiot and sound like they know what they're doing. So their people are going to give them certain talking points so that they can throw out a technical term on occasion and sound like they're actually doing the math. And then they go back in and they hop on their iPad. They're not on the computer doing anything complicated like you and I have done.
Jim, thank you so much for being here today with us. We will be watching this data closely as it comes in. It comes in every month, so we're going to be tracking this, see what these numbers say about your wallet in the future.